So I know all of you know this, but just in case you don't, if you sell puts, selling puts is bullish. If a stock closes below a put sale, you will get put shares, aka you will buy them at the strike price. Okay, so just for giggles, for hee-haws, what we're going to do is we're going to put this put sale at 90, and I'm going to go look at the expiration date of July 20th. I'm just going to see how much premium is here for August, and I'm going to go sell this put, and we're going to see if we get put some shares of Costco and literally get paid to wait to do that. All right, so we are at July 20th. Alan, you following me? July 20th. Okay, I'm going to go to August, and a $90 put sale brings in 32 cents. So I'm going to get paid $32 per contract. $32 per contract. I'm going to sell 3, which is 300 shares, to buy 300 shares of Costco at $90. I'm going to press play, and we're just going to see what happens. Okay, expiration date comes. Ladies and gentlemen, what happened to my put sale? So my put sale has expired worthless. It's now worth 0. And I captured $32 per contract times 300 contracts. So I made $90-ish in cash, doing absolutely nothing, waiting to buy a stock that I want at the price that I want. So what am I going to do? I'm going to do it again. And we're going to do this put sale until I get put shares at 90. So the next expiration is September. Looks like it'll be September 21st. And I'm going to go to the August 17th. Alan says, this is unreal. I wish it was, dude. All right, August 17th. And we're going to look at September 90. All right, I'm going to get paid $32 again. So you guys can see same exact expiration, same strike price. We're going to get paid $32 again. And I'm going to press play, and we're just going to press play until I get put shares. All right, team. Did I get put shares? Yes or no? Nope. So we're going to have to do it again. Made another $90. All right. So September, we're going to go to the 21. Next, we're going to have to sell really far to get some premium. So let's go sell January. We're going to have to sell really far out to actually go get any money at 90. So now we're going to get paid 94 cents per contract. So that's $94 a contract times 300 contracts. And we're going to sell this at January. So the purple line is the expiration. So I'm going to click play. And we're going to just wait and see what it does. So again, at this stage, we're not doing anything. We don't have to do anything. You sold the put. You're just now waiting. Nothing to do, nothing to see. You want the shares. You don't mind owning the shares. You're not worried about getting the shares. You're just waiting. You're waiting. We're waiting. We're waiting. We're waiting. You're doing nothing. No trading is happening. Did the put sale expire worthless, ladies and gentlemen? Yes or no? It expired again. So that means we can sell it again. And you can kind of repeat this process. And I'm just going to click play to see if Costco ever even goes to 90. Just to see if we ever would get shares, and we'll see what the day is. And it might not, maybe it doesn't. We could probably keep selling these put sales at 90 for a very long time. Now, question, with different analysis, with different indicators, with moving averages, do you guys all think that you could do different strike prices based on where the stock price is, based on what's happening and how it's interacting with them, based on other math, right? Are there other things that you could be factoring in to maybe even get paid more money, or to get in at a better price, or to use other moving averages or other indicators to help you go, wow, I could probably sell it here and get paid? In fact, let me just pause this for a moment and pull up my favorite moving averages, which is the 100-200 simple moving average. And imagine now, instead of selling the $90 put sale, you sell a little bit closer to the 200 when it's coming down to the 100. And what you'll notice is you probably this entire time would never have gotten put to shares. You guys seeing this? So let me talk about this strategy for a second. This is my second favorite strategy, which is selling puts. This strategy works, and I'm going to write all this down on the screen. Put sales are the exact same risk profile as owning stock. This strategy only works in bullish markets or when a stock does not go largely down. This strategy is only used if you can, should, want to, or would love, or are able to actually buy the shares. You with me so far? So you got to make sure you can buy those shares of Costco if you're selling those puts. This is a very boring, very low income strategy. So I want to be clear on this. Mark says it's better than a no income strategy. This is true. I make very little money from put sales. Like 4 to 6% a year. Maybe a little bit more, but it's not a lot. 4 to 6% a year. I'm serious. Like that's probably my max amount that I'll do put sales. And that's with, good technical analysis and knowing where I want to sell it and getting in. And this is in bullish years. So let me tell you this. I'm going to write this down in blue. You will always make more money being in the shares or directionally bullish. Put sales is a high probability strategy, and it only works in bullish markets. So I'm going to pause here for a second because I have a lot of things on the screen. I'm just going to answer some questions that you guys have. Alex says, so this is like getting paid to have a limit order out there in the markets. That is correct. Yep. Alan said, can you do the opposite in bear markets? Sell call options. Yes, that is absolutely correct. KP says, selling puts is like shopping during Black Friday discount, except you determine the sale price. That's very true. Very, very true. So make sure that you're looking down here at the bottom right-hand side of your screen. This strategy is only used to actually buy the stock. That is paramount. This is how I've seen all traders that I know lose money. This is how they lose money. They will sell puts in downtrending stocks with too many contracts that they cannot afford to actually buy the shares. And I'm going to go ahead and tell you this now. Not the collar strategy that I showed you, but buying call options, buying put options, and selling options on margin, aka credit spreads and put sales and call sales, is how every trader who will blow out their account will blow out their account. So if you've lost a crap ton of money trading options, throw a 4 in the chat pane. I'll be the first person typing a 4. That's how I lost my first, all the money, okay? Was trading options like a moron, like a giant poo-poo brain. I didn't know what I was doing. I had no practice. All I knew is I wanted to make a bunch of money. This is the fastest way to lose money, is to trade options. Make sure you practice them. Make sure you study them. Make sure you analyze them. Make sure you back trade like I'm doing and practice it and come up with your plan and come up with your strategy and come up with your system. Okay? Because once you can go, all right, let me understand this so that I don't lose, that's perfectly reasonable. But most traders will start trading. They'll start with options. They'll lose a bunch of money, and then they'll begin to learn the actual process. I haven't met anyone to date who has learned the collar strategy appropriately and blown out their account with a collar strategy. So that's the good news. I'm not saying it hasn't happened. I'm just saying I haven't met anyone who's ever done that. Now, are there some really, really garbage companies out there? Sure. And if you get into garbage companies and you don't know anything about how they do, and you heard it on a newsletter, and you went and bought the thing and you put a bunch of money into it and you got into a collar and you lost some money, I can understand that. But if you're getting into companies that you know exactly how they work, you like them, you use them, Walmart, it's going to be really hard to lose, especially if you're buying at a great price.